Exchange-traded bonds have given retail investors an avenue to access the corporate bond market following their launch in Australia in May. Joining me today to discuss the benefits XTBs offer and how they differ from other investment products is Australian corporate bond company Chief Executive and co-founder Richard Murphy. Welcome, Richard.
Thank you. Thanks for having me.
So, Richard, what are XTBs?
XTBs are exchange-traded bond units. Essentially, until now, you couldn't get access to a BHP bond, a Telstra bond, a Woolworths bond directly on the ASX because they're only traded in the wholesale market. So what XTBs are is a security that essentially takes some of that bond and puts it onto the ASX in a securitized form. So basically you can access now literally a BHP bond, a Telstra bond, a Woolworths bond, and 16 other or 17 other XTBs until a week ago. Then we launched 6 more. And then tomorrow we're launching another 6, and next week we're launching another 4. So it'll be an ever-growing number of individual securities that give you the returns from the BHP bond or the Telstra bond as if you were actually owning them. So they will live and die with the underlying bond, so that they'll be 3 years old, or 3 years to run, or 5 years to run, or 7 years to run, depending on the bond, and all of the coupons flow through to you as the investor, and the final principal flows through. So it's basically the idea is to take something that you couldn't get previously, which was access to the corporate bond market, which is an institutional market, and putting it onto the ASX to allow you to get access to it.
Okay, and how do they differ from other offerings in the market?
So if you look at broadly fixed income and equity, there's obviously been for many years on the ASX lots of equities, lots of listed investment companies, property trusts, and more recently exchange-traded funds, and they give you diversified exposure. And some of those are diversified exposure to fixed income. What this is for the first time getting access on an individual basis to individual corporate bonds that you otherwise couldn't get. You can also get access to hybrid securities, which are more risky and more volatile. Senior bonds, which these are a lot more capital stable. So this gives you access to them on an individual basis. So you could say, okay, I like Telstra, I like Lendlease, I like Horizon, and I like Qantas, and that's my portfolio, rather than having to go for a very broad portfolio, which may well be dominated by government bonds, which drags down the returns. So it gives different features to all of those other securities. And really, if you're looking at a portfolio, and if you're an advisor looking at somebody's portfolio, you really want to be diversified into different asset classes. So this one is giving you an opportunity to say, right, I've got my equities, I do have some hybrids, but they're a bit volatile. I'm looking for something that's a bit more capital stable in the fixed income class, and I don't want to go for a government bond denominated or dominated ETF or managed fund. Give me 5 of these or 10 of these or even 1 or 2 of these individual bonds because I like Telstra or I like Woolworths or I like Qantas, for example.